Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump is calling for de-escalation after Iranian and Israeli strikes hit major energy sites across the Middle East. An attack on Qatar's Ras Laffan gas hub caused significant damage, while Israel struck Iran's key South Pars field. The president says the U.S. was not involved in the Israeli strike and warned Iran against further attacks on regional energy infrastructure. Shares of Auto Canada are plummeting. They're down nearly 20%. Auto Canada swung to a fourth quarter loss on lower revenue. The Edmonton-based multi-location North American automobile dealership group says its fourth quarter performance was shaped by a more challenging market backdrop. Demand was affected by activity like the sunset of the Canadian EV tax credits that benefited the fourth quarter of 2024 and tariff-related policy changes that drove stronger demand in the first half. We're watching shares of Micron. They are off by about 2% right now, a little under. The tech company revealing plans to boost capital spending, which drew concern among investors. Still, Micron reported adjusted earnings well above estimates, with revenue of $23.9 billion US, also topping forecasts. Micron produces memory for NVIDIA and is benefiting from surging demand of NVIDIA's AI chips. And the TSX bouncing back a little bit, but still off by 1.6%. Materials driving that down. It was off more than 8% a little earlier. South of the border, similar situation. And the market's all in the red right now. They've improved a little bit, but same situation. The fears over the Middle East driving all this. The S&P 500 off by 0.6, the Dow by 0.8, and the Nasdaq by about 0.7. And the markets are under pressure after the escalating conflict in Iran sent oil prices higher, while both the Bank of Canada and Fed held rates yesterday. Concerns that the central banks will have to tighten monetary policy in the near future, to keep inflation in check are intensifying. Let's get more from Cole Kasher. Cole, thanks very much for joining us. You're Senior Investment Advisor and Portfolio Manager at Wellington Altus Private Wealth. I got to get that there is in there as well. Thanks for joining us. Just another day in 2026, isn't it?
It is, yeah, just another day, volatility moving the market. And, it's a little bit frustrating as an investor when, there's controllables and uncontrollables. And, this probably spike in oil prices shouldn't be happening or doesn't need to happen. So it's frustrating where, you invest in good companies like Micron or a NVIDIA and, you're seeing the stocks move down even though they've done everything right from an earnings perspective. So it's a good time to be patient, high grade a portfolio and, find companies that you think are really going to move up and, or maybe just kind of move into the side. While it's frustrating, these are great opportunities in the medium and long term.
All right, we're going to talk about some stocks you'd like to see, but first let's talk about the interest rates yesterday. No real surprise, and I guess no real surprise that we're now looking at a potential rate hikes depending on how everything unfolds.
Yeah, I mean, that's the issue. I think both, the Fed in the U.S. and at the Bank of Canada, I think they both love to cut. But, $100 oil really spikes inflation up, and inflation has been sticky, at the best of times over the last year. So it's really hard that, you can't really make it work, that you can cut and, get GDP growing a little bit, hopefully improve those unemployment statistics. So it's a little bit of a rock and a hard place right now, because I think the market knows what they would like to do, but with the uncertainty earlier in the year and still now, around tariffs, we don't know how that's all going to shake out. You get an oil spike, you get geopolitical conflict in, numerous places. And it's really no surprise the markets really just kind of has no direction, because it seems like, the world in general doesn't really have a lot of direction right now, and the market's just a piece of that.
And the oil shock we're looking at right now, what's a short term to you for it? Is it If it's over in a couple of weeks, could it be a couple of months and we could bounce back fairly quickly?
Well, I think it depends on, how things go over the next couple of weeks. If you keep destroying oil infrastructure, that's not easy to bring back online. A lot of these gas plants and, pipelines and other things that, seem to be targets. It's not like you can just bring that back on in, a week or so. So there's a lot of irony in Trump asking for de-escalation when, he's kind of the one who escalated in the first place. So, if cooler heads prevail and, there's realization that really war and specifically targeting critical assets aren't good for anyone, then I think oil should move back down, maybe to the $70, $80 range, probably not as low as where it otherwise would be just because of the constant threat of geopolitical activity and more. But I could see it moving down, and I think $75, $80 would be, a price where I think it could probably end up shaking out.
And also, we're hearing reports that the LNG plant, one of the LNG plants that provides about 17% of the LNG in Qatar, was hit today, and they were saying it could be 3 to 5 years before it's back fully online. If that's the case, what kind of turmoil does that create?
Well, I think it creates a lot. I mean, you can have all the oil in the world, gas, LNG, whatever petroleum product you want. But, if there's no infrastructure to get it to where it needs to go, whether that's, China, Japan, Middle East, US, it doesn't really matter. You're going to see volatility in prices, and, volatility in prices, generally it's upward, not downward. So, that's where the inflation comes in, and that's where you get the cascading effects on, interest rates and, everything else, which I think the market in itself, wars happen all the time, and we don't want to undermine the, personal consequences, but the market looks at, the long-term or medium-term impacts, which, we've kind of seen that over the last day and a half with no rate cuts, maybe a rate hike, which I don't think that was in the cards earlier in the year. So, it's just created a lot of uncertainty, and, with uncertainty, specifically after a good run in most markets for the last couple of years, uncertainty just might mean things head down or go sideways for a little bit.
All right, let's talk about some stocks that you've got your eye on. We were talking about Micron and NVIDIA. Amazon as well is in there for you, still liking the big tech?
Yeah, I think they're all great companies. Like, and that's the controllables. Like these companies, like Micron, it reported fantastic earnings yesterday, and the stock has moved up significantly in the last year. So it's, probably priced to perfection. And, the fact that it hasn't went up sharply just kind of shows that, sometimes you need perfection, and maybe that isn't even good enough. And I think NVIDIA is really in the same ballpark. When they had their investor day and they're talking about $1 trillion of future orders, and the stock moves sideways or down, like if that ends up coming to fruition, NVIDIA is going to be at like 12 to 13 times forward multiples, like lower than the overall S&P. So I just think that, if you take a longer term horizon on a lot of these companies, that the entry points that you're going to be seeing, maybe a little bit less so on Micron just because it has moved up so aggressively, but certainly on NVIDIA. And yes, I still like Amazon, even though, the rate cuts probably do hurt the consumer. But I think Amazon at this point is also, a little bit of an AI slash, tech play, just not the commerce. All
right. And there's also an ETF you're liking right now that you're keeping an eye on.
Yeah, I've traditionally liked the FAGMA ETF. It's the Evolve, basically ultra large cap. There's a lot of volatility in individual stocks, and for certain people and certain clients, myself included, it's sometimes nice just to wrap them up in an easy little bow and get exposure to some of the best companies in the world. And whether you do that through something like the S&P or the XQQ, or a little bit more targeted ETF, I think that those can go a long way to getting exposure to the right spots. But again, you have to be careful. Markets just don't go straight up. And, this time last year, I think at one point markets had corrected 22% on the S&P anyway. And, the year finished pretty strong. So it might just be one of these spring melees where, things just aren't really coming to fruition the way we hope. But I think markets could get higher. It's just a matter of some of these conflicts and uncertainty that's kind of a dark cloud right now. It's making it hard for a clear direction.
All right, Cole, thanks very much for joining us today.
Yeah, I appreciate the time. Thank you.
Cole Kasher, Senior Investment Advisor and Portfolio Manager at Wellington Altus Private Wealth. Up next, Uber is pushing into autonomous driving deals. We'll see why it is an attractive investment opportunity after the break. We are taking another look at Uber as it keeps cutting new deals in autonomous driving and next-gen transport. Earlier, we spoke with Michael Hakes of the Murray Wealth Group, who sees the company as a compelling investment opportunity.
The stock is off its highs of $100 about 6 months ago. And on Tuesday, most recently, it announced an agreement with NVIDIA to launch a network of robo-taxis starting next year in LA and then San Francisco. The bear case on the stock has been that autonomous vehicle players such as Waymo, Tesla, Zoox, which is owned by Amazon, will not need Uber to build their customer base in robo-taxis. We think Uber has an unmatched global network with hundreds of millions of users across geographies, and this will be crucial for those new robo-taxi platforms to gain customers. The NVIDIA deal is just one of several announced. For example, Uber also expanded a commercial partnership with Waymo and Zoox to offer fully driverless robotaxis, which are offered exclusively through the Uber app in some markets. Waymo, for example, is in Phoenix, Austin, and Atlanta. And Waymo supplies the autonomous driving system and vehicles part of the equation, where Uber handles the fleet operations, dispatch, maintenance, cleaning, and obviously the consumer interface. So why is this important? It's because it validates Uber as a preferred demand aggregator, as they call it, for leading AV developers. And by the same token, Zoox also has also just announced a deal with Uber for Vegas in the summer of 26 and then LA in 27. And this is the first time Zoox has partnered with a third-party ride-hailing platform. So this reinforces the role, Uber's role as a neutral marketplace for the autonomous vehicle supply.
All right, we've got a couple more we want to get to here. Primaris REIT, they just announced a new CIO. What puts them on your radar?
Yeah, we think apart from the new CIO, who I've heard is excellent, we think that it's trading at a discount to its NAV of over 18%, and this will narrow over time as the company executes its long-term strategic plan. If we back up a bit, Primaris is a Canadian retail REIT focused on owning and managing enclosed shopping centers. Mm-hmm. It yields over 5%, and it's trading at a significant discount, as I mentioned, to the NAV. But there are two primary catalysts. They made two transformative deals in 25. They bought two tier one enclosed malls, which they hope to transform and leverage in terms of their net operating income growth. And also, Primaris owns 9 to 10 Hudson Bay locations, not the downtown Toronto location as we know, but they're mainly in secondary markets. So when Hudson Bay last year entered creditor protection, that allowed Primaris to regain control of almost over 1 million square feet of prime real estate, and Imagine hopes to triple the income from these spaces through 27 by higher yielding projects. So that's why it's exciting.
All right, and we want to get one more in here, and it's just fun to say, EssilorLuxottica.
Yeah, EssilorLuxottica. For those who don't know, this used to be a company called Essilor and Luxottica, and they merged in 2018. Combined, they have between 25 to 30% market share in global eyewear brands, essentially. Ray-Bans, Oakleys. They also own leading lens technologies through Essilor, so those make the lenses for you, and they also operate retail footprint through, we've all heard of it, Lens Crafters and Sunglass Hut. So this scale means there's huge barriers to entry for Essilor Luxottica. And the long-term backdrop is supported by aging populations. My eyes aren't getting any better. Look at those, my glasses. The screen usage, we're using more and more screens, even though I can't imagine being on a screen any more than I already have. And of course, the steady growth in vision correction globally. There's also this other thing that you may have heard about, and that's the Ray-Ban smart glasses. You have an optionality in terms of the Ray-Ban smart glasses, or smart glasses broadly speaking, actually gaining traction after really years of sputtering on the sidewalk.
And that was Michael Hakes of the Murray Wealth Group. Coming up, today's market drivers with Bloomberg's Monique Molina.
By lies of fast cash.
What did you think was in the bag?
Trapping young Canadians.
She's a 19-year-old girl.
As unsuspecting drug mules.
People pay a lot of money for cocaine.
W5 goes deep inside Hong Kong.
There are 4 Canadians in prison right now.
To uncover a crime syndicate.
She wants us to expose these people.
Hunting for traffickers.
They just asked me to find people for them?
Here at home, W5's Avery Haynes investigates. Saturday at 7 on CTV and Crave.
Time to take a look at the market movers for today. We're joined now by Bloomberg Equities reporter Monique Molina. Monique, thanks as always for joining us. First up, Canadian solar taking a hit.
Yes, Canadian Solar shares fell as much as 30% today, which is the most on record for this company. They reported their fourth quarter earnings, and the earnings fell short of analyst expectations, and the company also gave a first quarter revenue forecast that also missed expectations. The company said that their global shipments fell in the quarter, and that really weighed on their earnings. And they're expected to continue to see some pressures in the global solar market going forward. Analysts said that this raises some concerns about how long it's going to take the solar market to recover, that it might end up being slower than expected, and that they think volumes are going to continue to be pressured, especially as some larger solar projects in the U.S. have been delayed recently. So they think until we see larger market recovery, particularly in the U.S., that this company's shares are going to continue to see some pressure.
It'll be interesting to see how it responds with everything going on with oil, which is what we're talking about next. And the oil shock is hitting hard certain sectors.
Yes. So we've seen a lot of movement recently on oil. A number of the energy companies, like the majors, like Chevron, as well as some of the gas companies like EQT, are seeing a lot of gains today after oil prices rose as much as 10% today. And this is because we've seen the actions in the Middle East really ramp up. We saw one of Qatar's energy facilities get hit by an Iranian attack today, and that's going to constrain the supplies out of Iran, which means less gas from that region. So people are going to have to look elsewhere, and where they're going to look is going to be some of these North American producers.
And also chemical stocks seeing a benefit right now.
Yes. So the chemical stocks, particularly in the fertilizer space and some of the petrochemicals as well. So that's like your Nutrien, your Mosaic. They're all seeing rises today. A lot of fertilizer products come out of the Middle East and are transported through the Strait of Hormuz. So this means that as these attacks are ramping up, as there's more constraints now on supply out of the Middle East, similar to oil, the people who need fertilizer are going to have to get it from somewhere else. And with these companies that are based in the US and Canada, their supply hasn't been disrupted, so they're going to be able to see more demand because of that. And with more demand also comes the ability to command higher prices.
And the last out of this, industrial metals, they're tumbling.
Yes, the industrial metals are really falling today. We saw copper fall back to the prices it hasn't seen since last year. It gave up all of its gains this year. We've seen aluminum falling as well, and those stocks in that area are really being pressured today because of that. They're seeing large declines, and this is largely because there's now more economic concerns due to the war in Iran. There's fears that with the rising oil prices that's going to raise inflation and hit other parts of the economy, and as a result, that could weigh on demand for these industrial metals and for some of the companies that typically use these that might have to pull back because of other costs that they're now seeing higher. Okay, we have to wrap it up there, but Monique, thanks as always for joining us. Thanks. Bloomberg's Monique Malima. When we come back, the CEO of Vital Infrastructure Property Trust joins us to discuss its rebrand after this. U.S. President Donald Trump is calling for de-escalation after Iranian and Israeli strikes hit major energy sites across the Middle East. An attack on Qatar's Ras Laffan gas hub caused significant damage, while Israel struck Iran's key South Pars oil field. Trump says the U.S. was not involved in the Israeli strike and warned Iran against further attacks on regional energy infrastructure. Meditech has priced its initial public offering below the deal's marketing range, and the company is also raising less money than originally planned. The UK-based Meditech priced its IPO on the Toronto Stock Exchange at $5 per share, raising a total of $40 million. The company initially set out to raise $50 million. However, the shortcoming seemingly reflects soft investor demand for IPOs in Canada. Uber plans to invest as much as $1.25 billion US in the car maker Rivian to help launch a robo-taxi fleet that will be available in Canada, the US, and Europe over the next 5 years. Uber and its fleet partners will buy 10,000 autonomous Rivian R2 robo-taxis and make them available exclusively on the Uber app starting in San Francisco and Miami in 2028. And taking a look at the markets and materials, pretty much everybody's down, but materials down by more than 8% at one point today. And you can see the TSX off by 1.6. South of the border, not much different. It's down as well all across the board there. The S&P 500 off by about 0.6. And the Dow and the NASDAQ off by about 0.75 of a point. Northwest Healthcare Properties has completed its name change to Vital Infrastructure Property Trust in what it calls an evolution into a focused healthcare infrastructure platform, and is now the only Canadian pure-play healthcare REIT. Here to tell us more is Zach Vaughan, CEO of Vital Infrastructure Property Trust. And Zach, thanks very much for joining us.
Thank you. Thank you for having me, and good morning.
A busy first 9 months for you. Are you settling in? What led to here?
Yeah, it's been a very busy 9 months. We I think our rebrand is really a reflection of what our business is, which is a healthcare infrastructure investment platform. The services that are performed in our facilities, which are hospitals, outpatient buildings, surgery centers, imaging clinics, et cetera, are really critical to people's everyday lives. And so we felt like the name Vital really was a really kind of captured that, and then having the name infrastructure included made sense to us because our assets tend to be very long let. And the cash flows are supported by either highly rated government credit or private insurance credit. And we're also seeing an increase in the number of dedicated infrastructure capital that's looking in our sector. So we do kind of straddle the fence at Vital between and could attract capital from infrastructure or real estate investors.
And with that, are you worried about, with everything that's unfolding right now, worried about that capital disappearing?
Well, I think what's happening, you mean in terms of just, the market today?
The market's in the turmoil and yeah.
Yeah, I think in fact it could send more capital our way. I mean, if you look at what we do, these are, our assets are hospitals, they're outpatient clinics, surgery centers, et cetera. These are very non-discretionary in nature. You're not really there. You tend to not defer decisions to go, and so. I think it could actually attract even more capital to our sector. We're certainly seeing more institutional capital looking to our sector, which historically was somewhat of a niche sector, and we're seeing those flows grow substantially. Obviously, we're just in a period of time of heightened volatility in the public markets, but I think the larger, more institutional investors are looking through that, and something like us is very well positioned.
And so it sounds like you're looking at more acquisitions. Where are you focusing? Any particular geographical or particular sector within health?
Yeah, so as we look forward, I think one of the challenges that we had, and quite frankly, one of the things that attracted me to the business was that although Vital owned assets in the right neighborhood, I think the business was misunderstood, partially as a result of its complexity operating all across the world in all kinds of different ownership structures. And so a really key goal we have is to simplify our business, not only by geography, but structurally. And so as we look forward, we're going to focus our growth here in North America. In Canada, in particular, it's a very exciting time. I mean, if you look at the demographic trends in Canada, in the next decade, about a quarter of the population is going to be over the age of 65, and we collectively, as Canadians, spend about $400 billion a year on our healthcare. And we do have in Canada, fortunately, some of the best large-scale, high-acuity hospitals, but that's not necessarily conducive to delivering general healthcare to an aging population. And so what we are seeing is hospital systems now increasingly moving from inpatient settings to outpatient settings. And these facilities are often smaller but highly specialized. And so delivering this next generation of healthcare infrastructure is a very meaningful growth path for us. For example, about 24 months ago, we delivered an ambulatory surgery center in partnership with Lakeridge Hospital in Pickering. It's about a 60,000 square foot building. So just in context, that's about the same floor area as a grocery store spread across 4 floors. It has 4 operating rooms, highly advanced. And as a system, Lakeridge has increased their surgical output by over 10,000 cases since they've opened the facility. Following that, in our quarterly results, we announced a commitment to build a $120 million facility with Royal Victoria Hospital in Barrie as well. So,
all right, I just want to jump in and talk about your international. If you're looking to refocus on Canada, North America, but you've got 133 properties around the world, what's the plans for them?
Yeah, I think we will over time. We've had assets in New Zealand. We've simplified our structure there, so we will likely exit that market. In Europe, we announced at the end of the year a transaction for 400 million euros to sell a substantial portion of our holdings there, as we plan to exit the region. So I think over time you'll see us with a portfolio in Australia and in North America. But it obviously takes some time to make those changes.
And just from the financial side, just looking at one of the numbers, your monthly distribution, 3 cents per unit. Are you satisfied with that? Where do you see that going, and how do you see it changing?
Well, I think we're at a period right now where we're because of all the change going on and the repositioning of the portfolio, we're in a good spot with that. I think as we reposition and redeploy some of this capital towards North America, we'll start to see some more growth in that, and we'll obviously review our distribution, in time.
Okay. Sorry, I thought you cut off there for a second. Zach, we're out of time, but thank you very much for joining us today. We appreciate it.
Thank you.
Zach Baughan is the CEO of Vital Infrastructure Property Trust. Coming up, we're looking at a 2022-style downturn if the Iran war drags on and the Strait of Hormuz remains closed. We'll have more on this after the break. Markets continue to drop. Oil prices are rising. The war in Iran continues to escalate, threatening the entire Middle East. Will the market's bull run driven by AI be sustained, or are we looking at a downturn? For more on this, we were joined earlier by Barry Schwartz, CIO, Portfolio Manager, Baskin Wealth Management.
In 2022, of course, the Russia-Ukraine conflict, and it's still ongoing, of course. You see how markets do eventually discount the issues, but of course, it's a shock to the world and a supply shock, and obviously the rising price of oil and natural gas, more so, of course, in Europe, could lead to another round of higher inflation, no rate cuts, really throw off the plans that the U.S. administration had for this year. And of course, the bottom line is markets could take a tumble as a result of that if it drags on. Absolutely, we could see very similar knock-on effects that we saw in 2022. Mm-hmm. But the opposite, of course, is 2025. Remember, we were all so depressed about the tariffs, and we all knew the impacts, and it was going to be horrible, and the markets were going to go down. And then by May, of course, it was all over, and the market started to recover. So obviously, this is a different scenario. I liken it more to the 2022 scenario. And so we all have to hope for a quick end. And if it ends by the end of this month, I think the markets will rebound quite violently as a result.
If oil prices do stay elevated for a long run, like more than the end of this month, as you're saying, and we do see a return to that 2022 style inflation, what would that do to the AI-driven bull run that we've been seeing?
It's hard to know what the knock-on effects are going to be. Obviously, the companies have committed capital expenditures to build out. If the economy starts to slow, they won't. They will stop buying chips. They will stop buying. People aren't going to travel anymore. If the price of oil and gasoline is going to impact the price of commodities and goods, then you could look for really a tough problem for the economy, and the knock-on effects will spill over. That being said, we have to obviously take a look at the price of oil, where it is today, the price of natural gas, and look at it in the context of where it's been over the last number of years. Is $95 oil outrageous? No. Is $3.20 natural gas price outrageous? No. But no question, the prices are much higher in Europe, and that's where the impact is going to be. If you look at it historically, inflation adjusted, oil prices are not expensive at all, and the economy can very easily digest it. We also have to keep in mind that we have a much different economy today than we did 20 years ago, or whenever, if you recall the Iran conflict multiple years ago when inflation spiked. The economy is not as much driven by oil as it was many, many years ago, but still you can't deny the impacts.
Given everything that's happening right now, correct me if I'm wrong, you think this is more of like a buying opportunity rather than a warning sign. Is that right? And if that's so, walk us through why you think that.
I'm a long-term investor, so I use every pullback in the market as a buying opportunity, and that's just the way a long-term investor should think. It's a gift every time the market adjusts, and it's not a surprise what's going on now, and it's not like stocks haven't reacted. You see the impacts. You have many, the only thing that's working is oil and gas companies. By the way, I'm pretty happy that gold's not working, because it just goes to show you that everybody's pounding the table. Gold's got to work when things are going crazy and things are uncertain. No, it doesn't. And so I really want investors to focus on the long term, own great businesses. You've been through this before. You've been through so much uncertainty. This is, this is nothing compared to what happened during the pandemic or 2022. Maybe it will be, but for now it's not. And you have to really focus on companies that are excellent at allocating capital and have been through tough times before. This is the way the world works. And so I'm going to focus on what matters, and that's corporate earnings, and so far have been very, very good. And I'm still expecting double-digit return on earnings this year, and hopefully the stock market will follow suit.
Yeah, okay. It's very interesting what we're seeing with the markets right now. I want to narrow into a couple of different companies, though, switch gears just a little bit. I wanted to ask you about Micron. So this company reporting strong earnings, tripled its revenue in the latest quarter, beat analyst estimates, but there's some big spending planned for this company, and we're seeing that reflected in the stock price today. What do you make of what we're seeing with Micron and the stock's response to these earnings?
So what's going on, of course, with the semiconductors is unbelievable, right? So we all know that in the past, semiconductors were very much a boom bust type business. They would all make too much money and make too many chips, and then we would have some kind of pullback in the economy or what have you, and Micron and those similar companies would tumble because it's really a commodity type business. It's memory and storage. They're not making special design chips like NVIDIA, but that being said, the stock, look at that. It's moved up incredibly. Yes, the numbers were unbelievably insane. I think they are guiding for $19 a share in one quarter. So something just blow away. But what the market obviously focusing on is how long is that duration of this demand going to last? And of course, what's going on with the world now, that could have knock-on effects. You just don't know. So the investors are right to be skeptical about these companies, but honestly, the numbers that all these companies are producing, NVIDIA said they're going to do $1 trillion of revenue on AI in 2027, and the market didn't even react to that. So right now, markets can't focus whatsoever on any fundamentals. It's all about what's going on in Iran. And until we get away from that narrative, expect stocks to be extremely volatile.
Okay, we're running out of time, but I did want to get to at least one of your stock picks for today. That's TMX Group, which has been losing listings on the TSX, but you're still bullish on this one. Why is that?
Listings is not how they make a lot of money. They make money on trading, on volatility, on derivatives, on also selling software and subscriptions. The listings business is really much a cash cow. But TMX Group, we think, is going to grow by double digits for many years to come. It had a terrific 2025. The worry was as we head into 2026, there'd be less volatility in the markets. Well, hello, here we are, lots of volatility. People trying to do lots of crazy stuff to try and protect their portfolios, buying options, going into different markets. And of course, with the strong rise in the TSX, we expect more listings and more new issues to come. So very exciting time to buy into TMX Group. It should be trading at $60 a share, but this is the market we're in right now. So we see lots of great opportunities and high quality predictive companies here.
Okay, we've got time for your last pick as well. So that's Berkshire Hathaway. What do you like about this one?
I love the new CEO, Greg Abel. Right off the bat, he wrote a gigantic shareholder letter laying out exactly what he sees and how he's going to play it out. Also, really putting the critics to rest, saying we're going to buy back stock if we want. We can do M&A. We're not just sitting on our hands. I said last year that Buffett was preparing the company to hand off to Abel, and he wasn't going to do very much. Now, Greg Abel's time to get going. What can be more defensive than having a company right now with almost $400 billion in cash, 40% of its market cap, as well as the ability to buy back tons of stock here. And if the market continues to weaken, we may see Greg Abel start ramping up the M&A. So very exciting time for a high quality business trading at a very reasonable valuation and guiding and telling you that they're going to be buying back stock here at these valuation levels.
And Lindsay was speaking with Barry Schwartz, CIO, Portfolio Manager, Baskin Wealth Management. Coming up, we'll look at how the heightened geopolitical tensions are reshaping the global insurance landscape. It's after the break. As the conflict in the Middle East continues to escalate, the insurance industry can still absorb losses from terrorism or political violence. But my next guest warns that if geopolitical tensions persist, insurers could face more underwriting volatility and tighter reinsurance terms. Let's get more perspective now from Marcos Alvarez, Managing Director of Global Financial Institution Ratings at Morningstar DBRS. And thank you very much, Marcos, for joining us.
Good morning, and thanks for having me.
What are the big challenges facing insurance firms right now?
Well, I think we have to differentiate between those on the property and casualty spectrum of the insurance business. Those are probably the ones that are going to be most affected because they I mean, some of those insurance companies can underwrite this risk in the Middle East or even beyond the Middle East in the case of terrorism and political violence. But also on the life insurance side, which I mean, for most of the viewers, this could be more remote because they don't think that they are actively part of a conflict such as the one we're seeing right now. They can suffer second-order effects due to volatility in financial markets.
And for the first group that's overseeing, I mean, those would be, I imagine that's the ships, that's people, buildings, things like that?
Marine, aviation, property, yes, exactly.
And
yeah, so, yeah.
No, go ahead. Sorry, go ahead.
Yeah, so we have some insurance companies and reinsurance companies because I mean this market also I mean it's global, and you see very large European reinsurers that are active in this market, and also Lloyd's of London. And yeah, so the business lines that are mostly affected at this time directly in terms of underwriting are aviation, marine, particularly marine, property, and political violence.
Now we've already seen ships being told not to go through the strait. Could that be expanded, and what kind of an impact would that have?
Well, so I mean, the situation that we have so far is that vessels cannot transit through the Strait of Hormuz, and that's a combination of the high cost or the high price of insurance, and also the lack of security conditions for these vessels to cross the strait. So. I mean, right now, this is probably limited to this area in the Gulf, the Persian Gulf, and the Red Sea as well. But because the marine insurance market is global, I mean, pricing effects can go beyond the region.
And now we heard President Trump say that they were looking at the Americans insuring the ships going through. Is that a possibility? Yes. Is it realistic?
Yes, that's a possibility, and this is something we commented on maybe 2 weeks ago. At that point, we didn't see that being enough to restart transit through the strait, and basically that's what we have seen in the last 2 weeks. I mean, safety conditions, operational conditions are still not there for most vessels to transit this strait, and even with insurance in place. And it's not enough for these vessels to take the risk, or for the ship owners or crews to take the risk of transiting through the strait. And one thing that I think we have to mention as well is that insurance has not been unavailable. The Lloyd's of London market and also the specialty reinsurers has been offering war risk insurance since the beginning of the conflict. At very high prices, yes, but it's available. Capacity still is in place for vessels that want to travel in the region with a special underwriting conditions and a special pricing. So the initiative put forward President Trump is supposed to complement this capacity, this private capacity. But again, it's not enough just to have insurance. There is a real risk of being hit by a missile in the region.
And so for investors right now, this sector, what do you do with it?
Well, yeah, I mean, the prices of the stock price of many of the global insurers and reinsurers, of course, have been affected. And I think we will also see some effects on big life insurers, which are not underwriting this risk directly, but they will suffer some volatility on their investment results. So, I mean, I think that we have to understand that the global insurance industry, in particular the P&C industry, because it's the most affected at this point, is well capitalized, is coming from a position of strength because of relatively high interest rates in the past 3, 4, 5 years. So they have built enough capital buffers during this time. So although we have been seeing a softening of reinsurance pricing in the last 12 to 18 months, we still think that the industry is in a good position to withstand potential losses coming out of the conflict, depending, of course, on the duration of the conflict and what type of losses we are seeing. Because from our perspective, from a credit perspective, what we are most concerned about is accumulation through multiple lines at the same time. So imagine having marine, aviation, property, and terrorism losses at the same time. So I think that's when we can see the industry having more credit concerns, but so far we have not seen that.
And what would be kind of, I guess I don't want to say acceptable losses, but what are losses they could absorb? How much? Do you have an idea on that?
Yeah, okay. Then let me give you some context. I mean, the property and casualty reinsurance industry probably sitting at a capital buffer of about $700 billion USD. So, an event of $50 to $100 billion is manageable. That would be, for instance, the size of a moderate to strong hurricane in Florida, 50 to 100 billion, and that's something that the industry can absorb.
Okay, we'll leave it there, Marcos, but thank you very much for joining us. We appreciate it.
Thanks again.
Marcos Alvarez is Managing Director in Global Financial Institution Ratings at Morningstar DBRS. Now, market calls coming up next, and today on the show we have Ross Healy. He is the Chairman of Strategic Analysis Corporation, and we'll be taking your questions on North American large caps. Let's take a look at the markets right now. I'm not sure we want to, but TSX, it is off again today by about 1.66%. Materials taking the biggest hit. Last time I looked, they were down close to 8% in that sector. And south of the border, really not much different. Only slightly less of a loss, I guess, if you want to look at it that way. S&P 500 off by 0.6, the Dow by 0.8, and the NASDAQ is off by 0.75. Now, one that is moving, though, is Rivian in the U.S. on the news that Uber is going to invest up to $1.25 billion in it. It's actually on the plus side. It's up 3.25%. And that's it for Morning Markets. I'm Roger Peterson. Thanks for joining us. We'll see you back here tomorrow.